Hey guys, welcome back to the channel. So today I want to talk a bit about the market rebounding. I want to talk about some of the earnings that are going on and ultimately how we can view the markets from here that can definitely help us with our investment strategies. So first of all, we have to note that it is impossible to really predict the short-term movements of the market. And this is mainly because of the emotional reactions from different investors. And this means that if we look at the market right here, we can, yes, say that we're still on our way to a bear market and the market always has rebounds in between. Or we can look at it and say, wow, earnings were that good, which I'm going to get into. And this is why the markets are starting to realize that although the Fed is talking about quantitative easing and raising interest rates, it still does not matter because of the growth rates, profits, and earnings that these tech companies are posting. And for me, I have not stopped buying stocks throughout this downturn. And even if it's going to continue to trend downwards, I will continue to buy. And I think what I'm about to show will portray the reason why. First, we have to understand that even if the Fed is going to continue raising rates, at the end of the day, the U.S. national debt just reached $30 trillion. And this means that if you raise interest rates too much, that just raises the interest that the U.S. government has to pay on its debt. So there's only a limit to how much they can raise rates. And we see on this graph where rates were back in the 1980s to where they are now. So even raising it by a few points does not make that big of a difference because people ultimately need a place to put their money. And when we look at these earnings, we're going to see why equities are a much better return than bonds. And as well, these big tech earnings I see as kind of a proxy for the economy. For example, Google, most of their money is made on ad revenue. And this means that companies are out there, small business, medium-sized businesses are out there actually advertising more than they ever were, which shows a strong economy. When it comes to Apple, the fact that they hit record highs in terms of revenue and profits, then that means that customers are ultimately out there still in the economy buying products and have money to spend. When you look at Microsoft, you see businesses are also doing fine. And when you look at Tesla, again, customers are out there buying. So I see these companies as really almost a proxy for the macro economy, and especially for tech growth because they have their chip suppliers and working with software companies. And tech growth is really the ones that got hit the hardest because they're considered overvalued or they trade at a higher multiple because you're pretty much paying for their growth rates. And the last reason why these companies are extremely important to the market and can really change the tide is if we look at this, we see that these companies are about 25% of the S&P 500. So if their earnings are this good and we have Facebook and Amazon coming up, then yes, they can really change the way the S&P moves, and that kind of change the whole risk on sentiment and market sentiment in general. So now I want to look at the recent earnings of some of the biggest companies, and this can maybe show why the tide may have turned in the market and why even if there is a shorter term downturn, it's still the best place to invest. So we see here with Apple that although we are having rising interest rates and although we have fears of a recession, as Elon Musk said and all that, the fact is they had over $120 billion in revenue. That is a record. If we look at their net income, they had almost $35 billion in net income. That is unbelievable. Again, that is another record. If we look at their growth, then we see that they grew for a company of that size at over 10%. So interest rates right now, the 10-year bond yield is at 1.7. Let's say it even doubles, right? Let's say it goes to 4%. We're still talking about a company this big getting $35 billion in net income at an 11% growth rate. And then if we look at the margins, when we're talking about supply chain issues and labor shortages and all that, we still see Apple's margins actually went up to 43% this quarter. So their gross margins are up, their operating margins are up, and their profit margins are up. This is incredible to see even with all the issues in the macro economy. Now, if we look at Microsoft, we see that they also had record revenues of over $50 billion. We see that their net income, it was not their highest, but it was still over $18 billion. If we look at their growth rate, it is 20%. So again, going back to the yields, we have a company here that is this big and still growing at 20%. And then margins, they pretty much were flat, a little bit down, but it's still extremely high. So not a lot of pressure there. Now let's look at Tesla. We see that they also had record revenues of almost $18 billion. Again, net income also record almost $2.5 billion. And if we look at their margins, we see that they also went up, and they are actually the highest of any automaker. And this is also with some one-time expenses that they experienced. And then again, when we look at their growth rates, it is over 60%. So another company that's hitting on all cylinders despite all the macro supply chain issues and that. Looking at Google, which reported last night and had an incredible earnings, they also had record earnings of about $72 billion. And then they have a record net income of over $20 billion. And their growth rate, being this size of a company, is also 32%. So these companies are growing extremely fast. And this is why when you look at the interest rates, it's just not really a factor. Although, yes, it definitely creates all this short-term emotional reaction from investors. Now I want to bring in AMD's earnings. And the reason why I'm bringing AMD is, one, it's not a big tech company. And also its stock got hit so hard. It was up over $150 and went down last week to under 100. And we're looking at it and saying, was this emotional or was it actually justified? And when we look at earnings and we see here that it was almost $5 billion, which is a record. When we look at net income, it pretty much a record, because in Q4 2020, they were able to recognize a tax benefit, which ended up making their profit close to $1.8 billion, but the true earnings was much less. So really we can look at it as the actual business hitting a record profit. When we look at their growth rate was almost 50%. And when we look at their margins, again, their margins are increasing. So again, was this justified or was it emotional? Could we have emotional reactions going forward? We definitely can. And I wanted to show PayPal's earnings. And the reason why is because I want to show how I do think the market is not irrational right now. For example, during the tech bubble, everything that had to do with the future of the internet and all that was going up. And it didn't matter what your profits earnings were. And I think here, if we look at PayPal, it was cut in half over the past 6 months to a year. And this is because it seems like the market is rational and understood that PayPal is decelerating in terms of their growth. And they have issues because they are separating from eBay. And the numbers do show that. I mean, we see the decline in net income and we see the decelerating growth rates. And PayPal is struggling at the moment, but the market is reflecting that. And I think this is with many stocks that haven't proven themselves and they've gotten hit very hard. And to me, that makes me feel good and makes me feel we're in a healthy market that is not just putting a high multiple on everything at the moment, and not everything is just going up because of its concept and the industry sounds sexy. But at the end of the day, companies have to perform, and that's what's driving their stock price. It's fundamentals. And we see from these big tech earnings that there is a strong reason to be in equities, especially some of these ones. I'm personally in Google and Tesla out of the ones I showed. And going forward, again, the short-term emotional reactions could definitely hit stocks, but ultimately look at the big picture, look where we're going, and look at these companies' growth rates and all of that. So I hope this video was helpful. Thank you so much for watching, and I will see you in the next video. Bye for now.